Welcome back. Today we're going over a super interesting company. It's also a magic formula stock, and it's one I'm going to be buying, which if you know me, you know that's extremely rare. I'm super picky about my stocks. I like to hold less than 5 total most of the time, and I just have very strict selection criteria, but this one checks all the boxes, so I want to show you why. Let's get started. So what I have here is their investor presentation and company overview. They published this sometime in May this year, and it's just kind of like an overview of the company and some highlights. I just want to show you a few things. So first off, who is Atkore? Atkore is a public company, and they are worth $3.6 billion. That's their market cap up top, selling for about $83 a share. All right, what do they make? They make a lot of the pieces and parts in non-residential construction. So wire baskets, cable trays, conduit, just other wirings, fittings, that sort of thing, okay? Electrical pieces and parts needed for infrastructure. And they got this neat slide here where they point out in the building where all their stuff is usually located. Thought that was interesting. I'll link this PowerPoint. I think if you're going to invest in them, you definitely need to read this. But anyway, all right, so that's the products. I'm just going to jump straight to their capital allocation plans. Okay, so this is the slide. It's called Capital Deployment Focused on Driving Growth. Okay, so this is showing you how they plan to deploy capital. All right, so you can see their 3 priorities are capital expenditures and organic growth. Organic growth means investing in your own business and growing capacity, or, adding on to your existing equipment, that sort of thing. Inorganic growth would be this: M&A, mergers and acquisitions. That's buying other companies or merging with other companies to grow inorganically. And then lastly, stock repurchases. So another thing, if you watch my channel, you know I love stock repurchases. I think they're way better than dividends, especially for stocks that are undervalued. And even though stock repurchases is last on the list, look at the money difference. So they're spending like $25 million in CapEx, about $40 million in M&A, and then look at this, $261 million they spent in the first half of the year in share repurchases, and then by November 2023, they've upped their total to $800 million they plan to spend on share repurchases. That's a lot of money, and to put that into perspective, I want to compare that to the market cap. So if you look at the market cap, it's $3.6 billion. So if they're spending $800 million in the next 2 years in share repurchases, that's going to be 0.8 divided by 3.6. So they're going to be buying back 22% of the outstanding shares if they stick with this, $800 million buyback plan. So that is super impressive. I'm going to mark that down because I want to use that later. So that's all I wanted to go over with the PowerPoint. There's a lot of other valuable information in there, but I'll link it so that you can read that on your own if you want to. All right, next we're going to go to the magic formula. So in case you didn't know, this is a website created by this guy, Joel Greenblatt. He wrote The Little Book That Beats the Market, all right? And basically he created a magic formula that ranks every US stock, 1 through however many thousand there are, and then ranks them in order of the most undervalued, or who they think are the best investments right now. Their criteria for the magic formula are really 2 things. They look at return on assets or return on invested capital. It's one of those, I forget which one. And then they also look at PE. Okay, so in a way, they look at return on capital to see how efficient is the company running, how good is it at deploying capital and making money on the assets it already owns. Then they look at PE to see how the market's valuing them, who's got a lower PE would be better, right? Higher return on invested capital would be better, and lower PE would be better. So he's got some formula, he ranks all the stocks and then puts them in order. All right, so you can go to this website, and I'll link this to magicformulainvesting.com. And basically you put the minimum market cap of 50 million, and I'm going to select the top 30 stocks. So the top 30 stocks above $50 million, according to the magic formula, are right here in alphabetical order, it looks like. And look who makes the list, okay? Atkore. All right, look who else makes the list. Smith & Wesson, huh? Be nice to own them too, I bet. Look, another interesting one is HP. I just made a video on them after Warren Buffett bought a huge chunk of HP. Anything that the magic formula's picking and Warren Buffett's picking, that's probably worth another look too. But really, any of these stocks on here are worth a second look. I am not a fan of just going by the computer screening and just creating a portfolio of 20 of these, but I think this is a great screening tool to get more ideas and do deeper dives on certain companies. All right, so there it is, Atkore Magic Formula. Now we're going to look at their stock price history over the last month or so. Okay, so this is just a 1-month trend of Atkore stock, and you can see since June, they've fallen 32%. I mean, we're in June, so since June 6th, they're down almost $40 a share, so 33%. And that's really what triggered me to start looking into them more, because I had looked at this company in one of my group screenings and I'd said everything looks great, but it was a little too expensive. So I put it on my watch list and just watched it fall. And now I'm at the point where I feel like I understand the business enough and it's at a low enough price that it's becoming a strong buy for me. So that's the stock price. Now let's move to the financial statements. I'm gonna look at total revenue first, and look at this. I mean, after COVID, they had a huge boom in revenue. They went from about $400 to $500 million a quarter up to $1 billion a quarter in revenue. So really climbed up there fast. Next, I want to look at their margins, okay? Because this is a great way to get a competitive advantage judge on a company, especially in these times of high inflation. A company that's able to maintain gross margin is really showing a strong competitive advantage because it means it can pass those increased costs on to its customers. So they did even better. They increased their gross margins. They were able to sell their stuff for an even higher margin than what they were buying it for. Now, this might not mean that they're intentionally increasing the price, but they probably were sitting on inventory at the time that went up in value rapidly as all these commodities went up in value. And so, they were able, from an accounting standpoint, it looks like they made a huge gross margin because of, the way that they count inventory and that sort of thing. But it's still super impressive. So what you really want to be careful for is looking for companies that are having to sacrifice gross margin during this inflationary period because they don't have the competitive advantage to pass those increased costs on to their customers. And this is definitely not one of those, right? Let's look at operating margin. Similar story here. Look at this jump here, man, from 10% operating margin to 30%. And then let's see, net income, net margin. Net margin, they were making, let's say, 8% net margin before COVID, and now you're at, over 20% net margin. The obvious question is this going to come back down to earth, okay? And that's the $1 million question as far as investing in this company, right? Let's go to pre-tax income, and I'll show you more what I'm talking about. Because if your revenue's going up and your margins are going up, your income is going to be on an exponential. It's going to go vertical, and look at this. Yeah, it does. Man, so this is one weakness, I think, of the magic formula, and it's something you really got to look out for. The magic formula can really overvalue like short spurts in growth because it makes it look so undervalued. And everybody else may be looking at this and thinking there's going to be a reversion to the mean, but that the magic formula I don't think takes into account future projections, so that may be where it's lacking, and that's one reason on top of many reasons why I don't go blindly buy magic formula stocks, even though I think it's a great tool. All right, so pre-tax income, they are making a ton of money. So right now, the most recent quarter, they made over $300 million in one quarter. To put that into perspective, I mean, the market cap's $3.5 billion. So they're selling like 10 times a quarterly earnings, okay? But that's not going to last forever, right? And I think anybody who just looked at this chart would think that, okay, there's got to be some trace back to some reasonable levels. And if you listen to their most recent quarterly webcast, one thing that the CEO, maybe it wasn't the CEO, but somebody said they're projecting like $1,200 to $1,300 million, so $1 to $1.3 billion of adjusted EBITDA in 2022. So that's about in line with this. But that by 2023, they are expecting their adjusted EBITDA to go to like 800 to 900, which y'all know I hate EBITDA. And then if somebody throws adjusted in front of EBITDA, that's just like even worse to me. So I took that adjusted EBITDA number and kind of used their calculation to reconcile it back to what I think the pre-tax income would be. And I got $690 million. Now that would put them, so 690 divided by 4 would be 172. So that would put them about right here. Okay, so I think that's reasonable. I'm going to go a little bit further and say that they're going to be go all the way down to like 150. Yeah, so 150 a quarter. So 150 a quarter times 4 will be 600, right? So I'm going to say a projected pre-tax income in the future of $600 million a year because 150 per quarter times 4. All right, now I want to look at their future earnings per share. And I always use diluted earnings per share. Y'all know that. And what I want to show you here is how we're going to account for these share buybacks, okay? So similarly to the pre-tax income, I'm going to project, a big drop off. Let's say down to 250, okay? So 250 per share per quarter times 4 would be $10 a share per year. All right, now that being said, that's if they don't buy back any shares. If they buy back shares, then this number is going to be divided by a smaller amount of shares, right? Okay, so how do you count for that? Well, I'm going to do 10 divided by 1 minus 0.22 because that's how many shares they're buying back. And I get $12.8 a share, so $13 a share, let's just say. All right, so that's what I think the future earnings per share is going to be, $13 a share, and the pre-tax income around $600 million a share. So that's the income statement. It's great. The earnings growth is amazing, but the question is, what's it going to look like whenever it comes back down to earth? Now, I think we still have a little while because they are going to go with the non-residential construction market. And I'm pretty closely related to that field, and that's not slowing down for the next year or two. Maybe residential construction and stuff might slow down a little bit, but the non-residential stuff, that's got a longer runway from what I'm seeing in the industry. Okay, so I feel like I do have some insight there. But that's me. Okay, let's go to the balance sheet and look at their total equities first. Okay. So I always like to look at total equity, and the reason I do is because to me this is the net worth of the company. This is everything it owns, its assets, minus everything it owes, the liabilities. So one thing I hate seeing is a company that is making a lot of money on paper, but their net worth looks like this. Okay, that's disgusting to me. Okay, so I like to see this. And you know what's also super attractive here is that even whenever they were making that lower income before the huge boom, they were still growing their equity. They were still compounding it pretty seriously. I mean, look at this. They went from what, $60 million to 200 in just a few years. I mean, that's serious equity growth. All right. So really like to see that. That's another check mark. All right, now we're on to the return on assets. So this is the other piece of the magic formula and the reason why it's so high on the list. Look at this return on assets. So I've said before, over 10% is good, over 15% is great. They're above 60% on return on tangible assets on a pre-tax basis. That's wild. This is one of the highest ones I've seen, and it's pretty awesome. We're also going to look at return on invested capital because I think that, looking at both of those is good. They should usually be about the same, but you always want to look at each one. And you can see, yeah, return on invested capital, even before the boom, they were still good. I mean, can you imagine, over 18, 15, 20% return on invested capital, and now you're getting 50% return on that capital? It's really strong. All right, let's see what's next. Debt to equity, we just want to look at their debt load, so make sure they're not super leveraged. And this is just total liabilities divided by total equity. And usually you want this, less than 2.5 is the rule of thumb. I like less than 1, and you can see they're at 1.25, so they're textbook good. I think that's solid, and it's decreasing, so it's showing that, management's either increasing equity or reducing debt. Both things are great, and we already went over the equity, right? So that's the balance sheet. Let's go to the cash flow statement. We're really just going to look at one thing here for the sake of time, and that is free cash flow. This is your total cash from operations minus your capital expenditures, which would be kind of like that organic growth that we talked about, their reinvestments into their business. So this is kind of hard to read. So what I'm going to do is insert a trend line to kind of help me a little bit, because cash flow is always going to be kind of all over the place. It's not going to be as clean as income, but that's just how it is. That's not a concern. What you want to look at is the general trend. All right, so you can see here, they're saying, and by they, I mean the trend line is looking like by 2022, 2023, we're expecting $100 million of free cash flow per quarter. I'm going to just bring that down a little bit and say that it's going to, retrace slightly and maybe be $80 million per quarter. That's just me, reading the sheep guts. Everybody else can have their own opinion, but that's going to be $320 million of free cash flow a year. Now I want to get a growth rate, okay? And I said that there's going to be about $80 million per quarter by 2023. So if I go 5 years back, they were at $50 million a quarter back here, okay? So 80 divided by 50, I'm saying they're going to go up 1.6 times in those 5 years. So if I raise that to the 1/5, I get what I think their compound growth rate is going to be, minus 1, and it's 9.85%. So I'm just going to put 10%. All right, so 10% growth rate. That's it for the cash flow statement. I'm going to move to valuation. First thing I'm going to do is just a quick rule of thumb, pre-tax income times 10 divided by the number of shares, right? So this one's easy. So $600 million per year is what I'm thinking for pre-tax income times 10. That's $6 billion. I'm going to divide that by the number of shares, and I get a estimate of $140 a share. All right, that's awesome. The next one is my earnings per share growth formula. And this is the last time you're going to see this on a video because I'm tired of this formula. I put it in because it was from Ben Graham himself, and I wanted a third formula because I thought it made it look good. But in my opinion, it super overestimates the stock price. So I'm done using it. Anyway, sorry if you used it before. I think I've always been upfront that I think it's an overestimate. So I know I'm just done using it now. All right, lastly, I want to do a DCF, discounted cash flow. And the way I'm going to do that is I'm going to put their free cash flow in millions, so $320 million. Their perpetual growth rate, I'm going to go down from the 10%. I'm going to say 8%. And then a discount rate, no, I'm gonna say 7%. Okay, so 7, and then a discount rate, I always discount at 15%. That's my opportunity cost in my mind. And so I like discounting at 15%. And whenever I do all that, I get a net present value of $4.6 billion. So $4.6 billion times 1,000 is 4,600 million. I'm gonna divide by 43 and I get $107 a share. All right, so I do have somewhat of a discrepancy between these two, but I think the average is pretty dead on. So the average is $124 a share. One thing I like to do, and this is a Ben Graham technique as well, is to find your margin of safety. Just take your average price target and then multiply by 2/3. So up here in the calculator, if I do 124 times 0.67, which is 2/3, I get a target buy price of $83, which is where we're at right now, 83.08, and it's 83.09. That's funny how that worked out like that, huh? It's crazy. So anyway, that's like what I would say is my buy price, and we're there, and it's gonna be one I think I'm buying this week, this upcoming market week. That's all I got. I hope you learned something. Leave comments, especially company recommendations. You know, this one was a recommendation, so whoever did that, thank you, and thank you everybody else for watching. I'll see you next time.